Gold is down 1.5% right now, sitting at 50.50. Silver is down 2.5% at 81.50, both getting hammered again. While a U.S. submarine just sank an Iranian warship off the coast of Sri Lanka, while the Strait of Hormuz is still shut down, while bombs are still falling on day 6 of this war, gold and silver are going down during a war. And the reason is sitting right in front of you on the dollar chart if you know where to look. You remember what happened Monday, that massive crash in gold and silver. Gold went from 5,400 to 5,000. Silver went from 96 to 77. Everyone was blaming the war, but nobody was looking at the dollar. The dollar pumped from 98.50 to 99.60 on Monday, $1.10 on the index. That is it. $1.10 on the dollar index caused gold to crash $400 and silver to crash $19. That is the power of the dollar. A 1% move on the dollar wiped out $400 on gold and nearly 20% on silver in one day. And right now the dollar's sitting at 99, heading straight for 100. And I need to tell you something right now that I do not think enough people are taking seriously. If the dollar breaks above 100, what we have seen so far in gold and silver is going to look like a warm-up. The crash could get much worse. I'm going to show you exactly why. I'm going to connect the dollar to every move you have seen in gold and silver. And at the end of this video, I'm going to break down the two scenarios that are about to play out at the 100 level, and one of them keeps me up at night. Stay until the end. But first, a United States submarine just sank an Iranian warship today. Let me start there. A U.S. submarine destroyed an Iranian warship off the coast of Sri Lanka. Think about where Sri Lanka is. That is not the Persian Gulf. That is not the Strait of Hormuz. That is the Indian Ocean, thousands of miles from where this war started. That means the U.S. Navy is now hunting Iranian vessels far beyond the Middle East. The war is not contained to one region anymore. It has gone global. When submarines are sinking warships in the Indian Ocean, the conflict has entered a completely different phase. This is not a limited strike operation. This is a full-scale naval campaign, and we are only on day 6 days. In 6 days, we have gone from airstrikes to submarine warfare in open ocean. Think about the trajectory. Day 1 was strikes on Iranian military targets. Day 2 was missile exchanges. By day 6, we are sinking warships with submarines in the Indian Ocean. Where are we on day 10? Where are we on day 20? The pace of escalation is faster than anything we have seen since the Gulf War. And the financial markets are trying to process all of this in real time while the dollar is ripping higher and gold and silver are getting caught in the crossfire. Now, here is why that matters for gold and silver in a way that most people are not connecting. When a war escalates to this level, the first instinct is to think gold should go up. Safe haven, fear, uncertainty. Gold goes up during wars. That is what we have been taught. And for the first few days of this conflict, that is exactly what happened. Gold spiked, silver spiked. Everything behaved the way the textbook says it should. But then something changed. The dollar started moving. And when the dollar moves, it overrides everything. Everything. War, fear, safe haven demand. None of it matters when the dollar is surging. And right now, the dollar is surging. The dollar index just broke back above 99. That is the highest level since mid-January. And here is what most people do not understand about the relationship between the dollar and gold. Gold is priced in dollars. When the dollar gets stronger, it takes fewer dollars to buy the same amount of gold. So even if the demand for gold stays the same, even if more people want gold because of the war, the price in dollars goes down because each dollar is worth more. It is not that gold is getting weaker, it is that the dollar is getting stronger. And the dollar is getting stronger for reasons that have nothing to do with gold and everything to do with what is happening in the broader economy right now. Let me give you a simple way to think about this. Imagine gold is a house. The house has not changed. Same size, same location, same demand. But the currency you use to measure its price just got 4% stronger. The price of the house goes down on paper even though nothing about the house changed. That is what is happening to gold right now. The house is fine. The measuring stick changed. And if you sell the house because the number on the screen went down, you just sold a perfectly good house because the ruler got shorter. That is what the dollar is doing to gold. It is distorting the measurement, not changing the value. Let me walk you through why the dollar is surging, because this is the part that connects everything. First, safe haven flows. I know that sounds backwards. Gold is supposed to be the safe haven, but the US dollar is still the world's reserve currency. When a global crisis hits, the first thing international investors do is buy dollars. Not gold, dollars. Because they need dollars to settle trades, to pay debts, to meet margin calls, to buy oil, which is priced in dollars. The demand for dollars during a crisis is mechanical. It is not about confidence in America. It is about the plumbing of the global financial system running on dollars. And right now, with a war raging and the Strait of Hormuz disrupted and oil prices spiking, the demand for dollars is through the roof. Second, The Fed just got boxed into a corner. The market was pricing in 2 rate cuts for this year. Now it is down to maybe 1. And that one got pushed all the way to September. Why? Because the war is causing oil prices to spike. Oil prices spiking means inflation. Inflation means the Fed cannot cut rates without making it worse. Higher rates for longer means the dollar stays strong for longer. Every day this war continues is another day the Fed cannot cut, and every day the Fed cannot cut is another day the dollar gets bid higher. Third, and this one is brand new, Trump just announced that the 15% global tariff is going to take effect this week. This week. Tariffs make imports more expensive. More expensive imports mean higher prices. Higher prices mean more inflation. More inflation means the Fed definitely cannot cut rates. And tariffs also reduce the trade deficit, which means fewer dollars leaving the country, which means the supply of dollars overseas shrinks, which means the dollars that are out there become more valuable. Tariffs are rocket fuel for the dollar, and they are starting this week, while a war is happening, while oil is spiking, while the Fed is frozen. Every single one of these forces is pushing the dollar higher at the same time. Fourth, the U.S. economy is actually strong. That sounds crazy to say during a war, but look at the data that came out this week. The ISM Services PMI showed the service sector expanding at the fastest pace since mid-2022. Jobless claims came in below forecasts. Productivity rose more than expected. Job cuts declined sharply. The U.S. economy is not breaking. It is holding up. And a strong economy during a war means the Fed has even less reason to cut rates, which means the dollar has even more reason to stay strong. Every piece of economic data that comes in strong is another nail in the coffin for rate cuts and another boost for the dollar. Welcome to the hidden economy. If you are new here, hit subscribe and hit the hype button right now. I break down the data behind the headlines that nobody else is showing you. Let us keep going. Now let me connect the dollar surge to what is happening in gold and silver, because this is the part where most analysts are getting it wrong. Gold topped out around 5,600 in late January. The dollar index bottomed around 95 at the same time. Since then, the dollar has rallied from 95 to 99, and gold has fallen from 5,600 to around 50.50. That is not a coincidence. That is the inverse correlation playing out in real time. When the dollar goes up, gold goes down, not because gold is weak, because dollars are strong. And the speed of the dollar rally is what made the gold and silver crash so violent. Silver is even more dramatic. Silver topped at 121 when the dollar bottomed back in late January. Now the dollar is at 99 and silver is at 81.50. That is a 32% drop in silver, while the dollar moved 4%. 4% on the dollar caused 32% destruction in silver. That is the leverage effect I keep talking about. Silver amplifies everything. It amplifies gold moves. It amplifies dollar moves. It amplifies fear and greed and everything in between. A 4% dollar rally turned into a 32% silver crash. And people are out here blaming the war. The war is not crashing silver. The dollar is crashing silver. The war is actually the reason gold and silver should be higher. But the dollar move is overpowering the war bid. That is how powerful the dollar is right now. And this is why I keep telling you that if you own silver, you need to understand the dollar. You can be right about the war. You can be right about supply deficits. You can be right about industrial demand. You can be right about everything, and still lose money in the short term if the dollar goes against you. Being right about the thesis and being right about the timing are two different things. Silver will eventually reflect the physical reality. But between now and then, the dollar can make your life very uncomfortable. That is not a reason to panic. That is a reason to understand what is actually driving the price. And right now, it is not the war. It is not supply and demand. It is the dollar. Period. Now here is where it gets really interesting. Dubai flights have been grounded because of the Iran conflict. Dubai handles 20% of the world's physical gold flows. 20%. When those flights stop, the physical gold and silver that gets shipped from Africa through Dubai to India and Asia just stops moving. The supply chain is broken. Physical premiums in Asia are spiking. India went from a $50 per ounce discount to full London parity in 48 hours. That means the physical market is screaming for metal while the paper price is going down. Sound familiar? Same disconnect I have been talking about. Paper says one thing. Physical says the opposite. And the reason is the dollar. The paper market is priced in dollars and the dollar is surging. The physical market is priced in local currencies. And in local currencies, gold is not crashing the way it looks on the dollar chart. Let me explain that because I think this is one of the most important things I can teach you. If you live in India and you buy gold, you are buying in rupees. When the dollar gets stronger, the rupee gets weaker. So even though gold is going down in dollars, it might be going up or staying flat in rupees, because the rupee is falling against the dollar at the same time. The gold crash you see on the chart is a dollar chart. It is telling you what gold is doing in terms of the US dollar. It is not telling you what gold is doing in terms of purchasing power globally. In many currencies around the world, gold is holding up much better than it looks on the dollar chart. The dollar is distorting the picture. And if you do not understand that, you will make decisions based on a chart that is not showing you the full reality. Now, let me talk about what is happening with the war, because day 6 is a turning point and the market is not pricing it incorrectly. Iran reportedly reached out to the US to explore peace talks. The New York Times ran the story. That headline alone caused the dollar to dip and gold to bounce briefly on Wednesday. Traders saw peace talks and immediately started pricing in de-escalation. Lower oil, lower inflation, Fed can cut, dollar weakens, gold pops. That whole chain reaction happened in minutes based on a headline. Then Iran denied it. Tehran said there were no talks and no outreach. The bounce reversed. The dollar surged back. And then Thursday morning, the submarine sank the Warship. That sequence of events in 48 hours tells you everything you need to know about this market right now. It is headline-driven, it is reactive, it is emotional. One headline from the New York Times moves gold $50. A denial from Tehran reverses it. A submarine attack sends the dollar ripping. This is not a market that is trading on fundamentals right now. This is a market that is trading on headlines minute by minute. And that is dangerous because headlines change by the hour, but the underlying structure of the dollar rally has not changed at all. And the reality on the ground is the opposite of de-escalation. We are sinking warships in the Indian Ocean. Trump is still saying the big wave has not happened yet. The Strait of Hormuz is still disrupted. And Trump is now saying the U.S. will ensure and escort vessels through the strait if necessary. That means American naval vessels escorting commercial ships through a war zone. That is not winding down. That is digging in deeper. And here is what the market is not pricing in. If this war continues for another week or two, the economic damage becomes structural, not temporary, structural. Oil stays elevated, shipping insurance premiums stay elevated. Every product that moves through the Strait of Hormuz stays expensive. Inflation does not come down. It gets worse. The Fed does not cut in September. Maybe they do not cut at all this year. And the 15% tariff on top of all of that is like throwing gasoline on a fire that is already burning. The consumer gets squeezed from every direction. Higher gas prices, higher food prices, higher import prices. And the dollar stays strong through all of it because the Fed cannot blink. This is the scenario nobody wants to talk about. Not a recession, not a crash. A slow squeeze where everything gets more expensive and the only thing going up is the currency that is measuring how expensive everything is getting. That is the nightmare scenario for gold in the short term and the best case scenario for gold in the long term. Because that kind of economic pressure is exactly what eventually breaks something. And when something breaks, the Fed cuts emergency style and the dollar drops and gold goes through the roof. The question is just timing. Let me tell you what I am watching to figure out when this flips. Because it will flip. The dollar cannot go up forever. And when it turns, the snapback in gold and silver is going to be violent. Here is what I am looking for. 1. The dollar index at 99 and change. There is major resistance right around the 100 level. The dollar has not been above 100 since early January. If it gets rejected at 100, that rejection could mark the top of this dollar rally and the bottom of the gold-silver correction. Watch the 100 level like your life depends on it. 2. The Fed. Any signal that the Fed is reconsidering cuts, any hint that they are worried about the war's economic impact more than inflation, any language that sounds dovish that will weaken the dollar and send gold and silver flying. Right now, the market is pricing one cut in September. If that moves forward to July or June, the dollar drops and metals pop. 3. The war itself. If there is a real ceasefire or real de-escalation, not a rumor that gets denied an hour later, but a real agreement, oil drops, inflation expectations drop, the Fed gets room to cut, the dollar weakens, and gold reprices higher. But if the war keeps escalating, we stay in this paradox where gold should go up, but the dollar keeps pushing it down. 4. Physical market premiums. If Asian premiums keep rising while the paper price drops, that divergence eventually breaks. And it breaks in the direction of the physical market, always. The paper market can fight the physical market for a while, but not forever. And the Dubai supply chain disruption is accelerating the tightening in physical markets. Every day those flights are grounded is another day physical gold and silver are not reaching the buyers who want them. That scarcity builds pressure. And when that pressure releases, it does not release slowly. Now I want to talk about the tariffs because this is the piece that nobody else is connecting to gold and silver, and I think it is the most important development of the week. 15% global tariff starting this week. Trump's Treasury Secretary says he expects the tariffs to revert within 5 months. 5 months. That means from now until August, we are living in a world with higher tariffs, higher import prices, higher inflation pressure, and a Fed that cannot cut rates. 5 months of dollar strength, 5 months of headwind for gold and silver in dollar terms, but also 5 months of rising costs for every American consumer. 5 months of economic pressure building. And when those tariffs come off, if they come off, the relief rally in gold and silver could be one for the history books because you will have 5 months of pent-up demand meeting a weakening dollar all at once. The timing matters. The war is happening now. The tariffs are starting now. The dollar is surging now. All of this is hitting gold and silver at the same time from multiple directions. That is why the volatility is so extreme. It is not one thing pushing the price around. It is 5 things hitting at the same time, and sometimes they push in the same direction, and sometimes they cancel each other out. War says gold up. Dollar says gold down. Tariffs say dollar up. Fed frozen says dollar up. Physical shortage says gold up. Dubai grounded says supply crisis. It is a 5-way tug of war, and the price is whipping around like a flag in a hurricane. And most people are only looking at one of those 5 forces. They see the war, and they say gold should go up. They see gold going down, and they are confused. But if you understand all 5 forces at the same time, the price action makes perfect sense. The dollar is winning the short-term battle. The fundamentals are winning the long-term war. And the price is stuck in the middle, getting pulled apart by both sides. That is not chaos. That is a market in transition. And transitions end violently in one direction. And here is what I told you at the beginning to stay for. The scenario that keeps me up at night. There are actually 2 scenarios, and both of them end with extreme moves. Let me walk you through both. Scenario 1. The dollar hits 100 and gets rejected. What if at the same time a ceasefire becomes real? What if tariffs get delayed? What if the Fed blinks? Any one of those weakens the dollar. If 2 or 3 happen at the same time, the dollar drops from 99 to 95 in a week. Gold, which has been coiled and compressed under dollar strength for 5 weeks, suddenly has no ceiling. Silver, which amplifies everything by 3 or 4 times, goes vertical. The physical market, which has been tightening with Asian premiums, spiking, and Dubai supply chains broken, suddenly gets a bid from the paper market too. The unwind is always faster than the buildup. The dollar took 5 weeks to go from 95 to 99. The reversal could happen in 5 days, and gold and silver would move accordingly. A 2% drop in the dollar can cause a 10% spike in gold because all the pent-up physical demand gets validated by the paper market at once. That is how you get the moves that make headlines. Now, scenario 2, and this is the one I warned you about in the opening. What if the dollar does not get rejected at 100? What if it breaks through? If the dollar index breaks above 100 cleanly, gold and silver are in serious trouble in the short term. 100 has been a ceiling for the dollar since early January. If it breaks that ceiling, the next resistance is not until 103 or 104. That is another 3 to 4% of dollar strength on top of what we have already had. Do the math. If 4% on the dollar from 95 to 99 caused gold to drop from 5,600 to 50.50 and silver to crash 32%, what does another 3 to 4% do? Gold could revisit 4,500 or lower. Silver could see the 60s again. I'm not saying that will happen. I am saying if the dollar breaks 100 with conviction, the math says those are the levels where the selling pressure takes us. The leverage effect on silver alone would be devastating. Every 1% the dollar gains above 100 could translate to 3 or 4% additional downside in silver. That is not opinion. That is how the inverse correlation has worked for the entire duration of this move. And this is why I said the 100 level on the dollar is the most important number in the world right now. It is the fork in the road. Rejection at 100 means the dollar rally is over and gold, silver rip higher. Break above 100 means more pain and potentially a lot more pain. Both scenarios end with violent moves. The only question is which direction. Think about what has been building underneath the surface during these 5 weeks. Physical gold premiums in Asia are at record levels. The Dubai supply chain is broken. Central banks are still buying. The Strait of Hormuz is still disrupted. The war is still expanding. All of that fundamental demand has been accumulating while the price has been going down. That is stored energy. That is a spring being compressed. And the dollar is the hand pushing the spring down. If the hand lifts, the spring explodes upward. If the hand pushes harder, the spring compresses more, but the eventual release becomes even more violent. Either way, this ends with a massive move. The energy does not disappear. It transfers. That is what this volatility is building toward. Not chaos for the sake of chaos. Resolution. And the resolution lives at 100 on the dollar. Watch that level like your portfolio depends on it. Because it does. Drop a comment. Tell me if you think the dollar breaks 100 or gets rejected. Tell me if you think the war ends or escalates. Tell me what you're watching right now. I will pin the best analysis. I want to say something real for a second. I know a lot of you are stressed right now. You own gold. You own silver. You have been watching the price go down for weeks while the news gets worse and worse, and it does not make sense. It feels like the world is broken, like the markets are rigged, like nothing works the way it is supposed to, but the markets are not broken. They're just doing something that most people have never seen before. The dollar is overpowering the war bid. That is rare. It has happened before, but it is rare, and it does not last. The fundamentals always win eventually. The question is whether you understand what is happening well enough to not make a mistake during the transition. That is what this channel is for, not to tell you what to do, to make sure you understand the mechanics so you can make your own decision from a position of knowledge instead of a position of fear. Share this video. There are people in your life watching gold and silver crash and blaming the war when the real story is the dollar. This video explains the connection. Help me reach them before they make a decision based on the wrong chart. If you are new here, hit subscribe. I break down comics, data, dollar mechanics, war impact, and physical market disconnects that nobody else is covering at this level. Links to everything in the description. This is the hidden economy. Day 6, Warship destroyed, dollar at 99, tariffs starting, Fed frozen, Dubai grounded, gold at 50.50, silver at 81.50, and the 100 level on the dollar is the most important number in the world right now. Watch it. Follow the data, not the noise.